Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
On today's show, we have three major stories shaping the global economy. First, Europe just accepted a new US trade deal with a steep 15% tariff and a massive $600 billion investment pledge that has German automakers calling it an existential threat. Then, we'll turn to the high-stakes US-China negotiations, where a failure to meet an August 12th deadline could trigger 145% tariffs on everything from AI chips to pork cranes. And finally, President Trump is gearing up for new tariffs on semiconductors, a move that could add $200 to every new car and puts TSMC's US factories in a difficult position. It seems Europe has just blinked. After months of tense negotiations, the European Union has accepted a trade deal with the United States that's being called a major reality check for its economic power. The headline number, a blanket 15% tariff on European goods. This is a stark contrast to just months ago when EU officials were pushing for a zero-for-zero pact, convinced they had the economic heft to stand up to the Trump administration. Considering US tariffs on EU goods previously averaged around 1.5%, this new deal is a landing point one official admitted would have been scarcely imaginable. So, what happened? The pressure came from within. Europe's own export-oriented businesses, from Finland's Nokia to Swedish steelmaker SSAB, pushed to end the uncertainty. As one EU diplomat put it, "We were dealt a bad hand. This deal is the best possible play under the circumstances." But that's not the whole picture. The real turning point is the stark asymmetry in the final deal. Not only is the EU expected to call off any retaliation, but it has also pledged a massive $600 billion investment in the United States. That pledge isn't just a number, it's a huge capital outflow from an economy trying to recover. What's truly baffling is the lack of detail. The deal doesn't specify if this money will come from public funds, straining EU budgets, or if it's a commitment that private European companies are now expected to fulfill. This ambiguity makes the pledge a massive question mark over Europe's economic future. The EU's threatened retaliatory measures totaled 93 billion euros, less than half its nearly 200 billion euro goods trade surplus with the US. They simply had more to lose. It became clear the EU lacked the weapons for an all-out trade war. When targeting US services was considered, there was no clear majority to go after digital giants like Netflix, Uber, or Microsoft, partly because Europe lacks homegrown alternatives. And this reveals a deeper structural vulnerability. This isn't just about lacking a European Netflix, it's about a fundamental weakness. The United States has a massive trade surplus with the EU in digitally enabled services. In fact, over 90% of the Western world's data is stored in the US. This digital dominance has become a powerful tool of geopolitical leverage. Europe's failure to build its own tech giants comes down to fragmented regulations, less access to venture capital. We're talking $150 billion in the US versus just $40 billion in the EU in 2020, and a more risk-averse culture. This digital dependency is Europe's Achilles heel. Now, a German export association is calling this a painful compromise and an existential threat. And believe it or not, this isn't just rhetoric, the impact is quantifiable. Research shows German car makers like Mercedes-Benz and Volkswagen are projected to lose over 10 billion euros in cash flow in 2025 alone. For an industry where parts cross the Atlantic multiple times, a permanent 15% tariff forces a complete overhaul of their business model. Their president issued a stark warning, "Let's look on the past months as a wake-up call." This all leads to the question of whether this is a one-time compromise or the moment Europe's ambition collided with reality. To counterbalance this, the EU is already scrambling to forge new alliances, aggressively pushing partnerships in critical tech sectors with Japan, and even exploring collaboration with the Trans-Pacific Trade Bloc. It's a strategic pivot to build a new kind of economic resilience. While Europe scrambles to find its footing, another high-stakes negotiation is coming down to the wire. The global economy is holding its breath over a single date, August 12th. If the US and China fail to strike a deal, tariffs could snap back to a staggering 145% on the US side and 125% on the Chinese side. Right now, senior negotiators US Treasury Secretary Scott Bessent and Chinese Vice Premier He Lifeng are locked in emergency talks in Stockholm. Their mission is to defuse this ticking time bomb. Without an agreement, we're looking at complete turmoil for global supply chains. And the pressure on China just intensified. The US recently locked in that massive trade deal with the European Union, which includes the jaw-dropping $600 billion investment commitment. That deal sets a powerful precedent, and now all eyes are on Beijing. The reason this EU deal matters so much is that the US and EU could fall back on long-standing political alliances to get it done, with the EU committing to buy $750 billion in US energy in return for a 15% tariff. That willingness to negotiate has been absent in the China talks, which are tangled in much deeper dependencies. This is where the situation takes a more complex turn. Beneath the surface, this isn't a simple tariff dispute. It's a targeted fight over critical technology. The US is using export controls to block China's access to advanced AI chips, costing companies like Nvidia billions. Interestingly enough, the fight even extends to the giant cranes in US ports. A recent investigation found about 80% of them are made by a single Chinese company, and some had unauthorized cellular modems installed, raising serious alarms about potential espionage or even remote sabotage. The US is challenging China's entire state-led export-driven model. In response, Beijing points to US tech controls as a direct attempt to stunt Chinese growth. Actually, shifting away from that export-driven model is incredibly difficult for China. Its economy has been plagued by massive overproduction in sectors like steel and EVs, weakening domestic confidence. Without a strong social safety net, Chinese households save rather than spend, making a pivot to a consumption-based economy a monumental challenge. And China is holding a powerful card, its grip on rare earth minerals, which are essential for everything from military hardware to car windshields. To give you a sense of their dominance, China controls over 95% of the world's rare earth processing. We've already seen them restrict exports of other critical minerals, causing global shortages and price spikes. So, what's the real end game? With a US trade deficit, with China hitting $295.5 billion in 2024, the stakes have never been higher. Can this kind of high-pressure diplomacy actually force a change in a nation's economic strategy? History offers a cautionary tale. The 1930s Smoot-Hawley Tariff Act, meant to protect US industry, instead triggered retaliatory tariffs that worsened the Great Depression, a powerful reminder that trade wars can have devastating unintended consequences. Speaking of high-stakes pressure, the global semiconductor market is on a 2-week countdown to its own massive shakeup. The Trump administration has announced it will release the findings of its national security probe into chip imports, with President Trump already signaling that higher tariffs are on the horizon. Now, when you hear national security probe, it's not just political jargon. The government's concern is twofold. First, there's the massive reliance on foreign-made chips, especially from Taiwan. A disruption there could cripple key American industries. But there's a deeper fear, the potential for espionage through hidden hardware backdoors planted in those chips. This isn't just a threat, it's a core negotiating tactic. Commerce Secretary Howard Lutnick confirmed the investigation was one of the key reasons the European Union came to the table for its own trade deal. This situation presents a fascinating duality for the EU. On one side, they get short-term tariff relief, but on the other, they are making huge concessions like committing to purchase hundreds of billions in US energy and defense products. This could divert billions of euros away from their own EU Chips Act, effectively trading today's tariff relief for long-term strategic autonomy. And that deal already has teeth. President Trump and European Commission President Ursula von der Leyen have announced a framework that slaps a 15% tariff on most EU imports. For the auto industry, that number jumps to a staggering 25%. And that 25% tariff on autos, well, that hits consumers directly. According to S&P Global Mobility, it could add about $200 to the cost of every single vehicle sold in the US. However, if you zoom out, you'll see another layer of strategy at play. This probe, conducted under the same law used for steel and aluminum tariffs, is part of a much larger trade strategy that includes investigations into copper and lumber. This is on top of a 10% tariff that took effect in April, set to increase sharply for most trading partners on August 1st. The central conflict is crystal clear: force companies to build in America or face the consequences. President Trump stated that companies from Taiwan and elsewhere would be investing in the United States specifically to avoid these new tariffs, a direct reversal of the previous administration's strategy of using CHIPS Act grants as incentives. Now, get this. Forcing companies to build here isn't as simple as it sounds. Building a cutting-edge semiconductor factory, or fab, in the US is incredibly expensive. Some say 4 to 5 times more than in Taiwan. This is why TSMC's new plant in Arizona has faced delays and cost overruns. So the big question is whether tariffs will be enough to overcome these hurdles, or if they'll just incentivize companies to build factories for older legacy chips instead. The carrot has been replaced by the stick. The administration is betting that tariffs can rebuild an industry on American soil. Experts are deeply divided on whether this will work. Some argue it creates a confusing message, offering subsidies with one hand while punishing imports with the other. The Information Technology and Innovation Foundation projects a 25% tariff could actually shrink the US economy, and the Semiconductor Industry Association itself has warned that tariffs could jeopardize chip availability and undermine America's own technological leadership.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.